I'm doing great, guys. Hopefully you can hear me. Did a little background music this morning. Yeah, very quiet markets today. Just let me know you guys are hearing me okay. Just doing a sound check. Awesome. Okay, folks, yeah, we'll be getting started here in just a couple minutes. Got a few more things to do to get things set up. Get a few minutes late start, but not too bad. All right, folks, just a couple more minutes. You know that sound. It's Runa time. Welcome, everyone. It is Wednesday. We had a meeting, Jay and some other associates yesterday, and my week kind of starts on Sunday, and the next thing I know, it's Friday morning. So things go pretty quick. Got a lot going on. I know you guys saw my offer on the software, just really trying to get folks on our platform because we want to get you folks out of speculating and start managing your money professionally. And so anyway, welcome everyone. So a lot to talk about. I'm stuck on this inflation story. I talked a lot about this last week, and I just think there's still a lot of things going on. We're at the end of a quarter here. We're at halftime of the year, and there's a lot ahead of us yet. And somebody mentioned the markets are quiet. Yeah, the markets have no clue what to do. And I've been talking about this on my nightly videos, is we're just getting this creepy crawler. It just keeps kind of crawling up. You know, maybe 0.5% is a big day, especially just focusing on the S&P. So that certainly has been a focus for a while. So the things I'm going to want to talk about today is I want to talk about some of the crazy money situation that's going on that we all know about. I want to talk about what I think is going on. And I've told you folks a number of times in the past that I believe the S&P is going to be your best inflation hedge, and it's going to be your best, I guess, play against or with the monetary onslaught of all this cash they're throwing into the markets. And this is going to be a continuing theme. It's not going to go away anytime soon. Got a couple of charts I'm going to show you I think illustrate some things of at least a market consensus, and then I'm going to be a bit of a contrarian, and that's not unusual for me to be a contrarian. Sometimes the crowd trade is the right trade. A lot of times it's not, and you know there's just a lot of people talking about real estate collapses and all the craziness. And there's two things that happened today that surprised me already. Is the ADP report came in at 692. I thought it was going to come in around 590, 100,000 more, but it's still much better. And then the housing numbers just blew off the top. That surprised everyone. And I thought we'd continue to see the soft housing numbers that we've been seeing. In the big scheme of things, it really didn't matter from that standpoint. Markets are pretty quiet actually, as far as the overall picture goes. So if you folks hear any really weird noises, I'm not being attacked. They are building a truck stop behind my office, and they've been a bit noisy this morning. So I was hoping they get some of their digging done before we start the show. But it's going to be interesting. I'm actually looking for a new office. I don't think it's going to work for me when there's 18-wheelers driving literally 30 feet beyond my building here. So anyway, enough, I digress. But the things that I want to talk about today is the impact of these negative real rates that we have. And and I'm going to go through an interest rate scenario. I'm going to continue on that theme. There seems to be, that's probably the biggest debate out there that I know of. the let me get some notes out here, and just want to make sure I cover everything I want to go through today with you folks. Yeah, so let me put up a screen here. I'm going to go on a half and half screen here, just so we can share this a bit together. Bear with me while I adjust things just a touch here. Just want to get this. Thought I had this set up right. Here we go. Okay, so a couple charts here. One is the projections of, these are coming from central banks, and they're kind of compiled. I found this graphic on the internet, and I thought it was interesting to help to build some of this story I'm talking about. But as we go out from 2020, all of the projections by the central banks are basically a negative GDP, down to negative 1.5%. So they're actually projecting a recession as we go forward, which is interesting. But the way that they're actually maintaining these, I will even call them phony GDP numbers, is they're borrowing from the future. So the chart on the right is showing basically the debt, percentage debt. We're up to, on a global level, we're up to 365, 370% of GDP. So they're borrowing against future debt to future returns to make it look good now. And we know this, right? You'd have to have been asleep, Rumpelstiltskin asleep for 10 years not to know that this was going on. The whole QE and what the Fed's been doing is very obvious, okay? So I'm telling you what you already know, but just stay with me for a few minutes, because I think what's really happening here is they're going to continue this pattern, and I'm going to show you a couple charts, which is the consensus trade, because these two charts are coming from the markets. They're actually swap charts on inflation, and I'm going to show you one that has year-over-year kind of expectation for the next year versus a 10-year expectation. And this is what just about everybody argues about. I had a debate with a good friend of mine in London the other morning, and morning my time, evening his time, and he's more in line with the concept of being that this is transitory and it's going to come in, and this is where the market's at too. So let me show you a couple of these charts, and it'll help me get through some of my dialogue here. So this chart I just put up is the 1-year inflation swap, and what this is telling us is the expectation is 3.6%. That's pretty much the reports that we've been seeing come out, and that's where the market's at. So if we and I'll go through this. I don't have a chart for this particular scenario, but we're looking at the yields around 1.44 now. We'll call it 1.5 just to round it off. And you're looking at a 3.6. So we have a 2.1% negative yield based on inflation at the moment. And so I argued going back a year ago when the crisis started that we would not have negative yields, and when I said that, it was like real numerical negative, like we weren't going to go into like Europe and go into sub, where you have to pay them, and we didn't really do that, but they did manage through the inflation, through all the money they spent to get us to those negative yields, and we're literally at 2.1%. I would probably even argue that we're about the same as Europe, even with the negative yields. Maybe Europe's a little worse from that standpoint. But what the Fed is, I'm going to go through, I'm going to start the show basically at the interest rate talk today, and I'm going to bring up trade station. We're going to look at some yields and just unpack this entire scenario, because I think this is what everything's going to be about. And I think there's going to be benefits of some of the things I'm talking about. Financial sector probably going to do reasonably well as we come into, maybe 22 and beyond, because they're going to continue to engineer all this stuff. And as I may have said on the channel before, but we're all living in Japan anymore. The model is Japan. And let's see here. I actually took that chart off. I had it on my available, but I took it down actually. And now I wish I hadn't. But the Japanese are the buyers of all world debt because they can still get a positive yield in their current situation. But as we look at this 1 year swap, we know this 3.6. This is pretty much where the CPI numbers coming out. And both of these indexes, these swaps are being based on a CPI, not on the PCE like the Fed likes to use. So they're a little different, but they give you the market expectations. And that's really what I'm trying to set up here. So here is the consensus. This next chart here is the 10-year is saying it's starting to already price in on a 10-year basis that we're going to get back at 2.4, which is somewhat in line with where the Fed wants us to be. So my argument, which I've been making for a while, I believe that all of this money pumping, everything they're doing right now is going to keep things elevated longer than they think it is, even longer than the market thinks it will be, because the market's already starting to price in that transitory yield. So they've bought into the scenario. And I talked to you about this last week. I recall that one of the things that the Fed does is they do jawboning. They try to influence market sentiment so they don't have to do everything they don't have to actually buy a lot of stuff that they did. Like a lot of the money that they printed last year and the bonds and everything they said they were going to buy, they never had to buy them because everybody else bought them and the markets bought them for them and boosted, I remember TLT was in the dirt and they just bid that up, and the Fed did some buying, but they didn't have to do all the buying they said they were going to have to do because they convinced all of us market participants to do it for them. And so the money and the cash flow went right in there, and that was the result. So I want to back up. So, but as we continue to look at this chart for a minute here, is you look at this trend, there's a clear trend of, even on a 10-year basis, trending higher and higher, right? So my argument is going to be that the 3.6 that's on this chart if we were looking at it like it was a stock, this is like a fourth wave consolidation, and we're going to see another leg up. And I think we're going to see something greater than 4%. I don't think we're going to the 1970s and 15% and all of that, but I do think we're going to be going to that next level at 4.5. I don't know how high it will go, not 15, but it is going to continue to go higher. And it's going to be very interesting because as the economies come on, we're on YouTube, so I need to be careful what I say, but there are things going on in the health area that are trying to perpetuate some situation, and a lot of talk about different types of actions that they took before, trying not to say anything, to control the markets again. So that's possibly where they're going to continue this reconstruction. And if you went back, I think, and watched April 2020 videos on the channel, April, maybe May, maybe even March, right when the stuff was hitting the fan, you would know that I was talking then about all of the pumping of the money and all the effects that ended up happening. And of course, it became clearer as we got into May and June of last year that this thing was just going to explode on the upside. And and all of the metrics that I used to do my analysis was very clear in that markets were going to continue to expand or therefore rally. And so those are things that I think are important. So what I want to do is we're going to go over to, So what I want to do is I'm going to go over to the 10-year, which is down, this is a weekly chart of the 10-year, and we're down to 1.44. I laid out some parameters in, I think it was last night's video, that the downside is somewhere between right where we are right now, 1.44. Extreme would be 1.38, and on the upside it's about 155 to maybe 1.6%. So what we're seeing here is this consolidation. You can look at the trend here, and you're seeing it just continue to flatten out here. My expectations are we're going to see yields start to rally again, or in this case, sell off. The bonds would sell off, yields will go up, and we're going to ultimately get to at least this 1.9 level. We're going to go through and talk about some of the longer term aspects as well. But the only way I believe that's going to happen is that we start to see some inflation metrics as we go forward that are a little hotter, as I just suggested they're going to be. I don't see anything dropping down right now. I know I'm actually going to bring up lumber here in a little bit because I think there's a story being told there as well. And all of the, corn, copper, all the big trades that were out there in the commodity world are starting to pull back. And I'm going to try to focus in on some of that stuff today. There's really, as someone pointed out, there's really not much going on in the indexes right now. S&P up 1.75 on the session, and even the NASDAQ that has the most possibilities here, is negative. So there's not really much to talk about. So I'm going to go down this thread. In a minute when I finish this, I'll see what you folks are talking about. I don't want to distract myself at the moment. But I guess the overall scenario, what's going on, even though we're at 1.5, I think we're too deep into that negative territory. I talked about 2.1's way too much. I think I'm going to show you the yield curve here in a minute. The Fed's made some big adjustments on the yield curve, and they're doing it with the 10-year, and that is why the 10-year is coming off. So now we're getting a thunderstorm. This ought to be interesting. Hopefully I don't lose power. We actually do get rain in Arizona. But this pattern that we're seeing here on the 10-year is the Fed's been pressing the yield curve, and I'm going to show you that in a minute. And this was one of my big scenarios going back to those levels I was talking about in April and May of last year, is that the yield curve was just they were going to steepen the yield curve. They were not going to let real yields go negative, even though on what I mean is numeric, it wasn't going to go negative. The 10-year wasn't going to go a negative number. But the patterns that we're seeing here is set up, and I believe we're getting very close to a bottom. There may be another week or so. We may slide along this line that we've been in for just a little bit longer, and then ultimately we're going to move up above that 175 level, which was everybody was panicking. And I think this is going to start to happen as we go forward. And I don't know if you folks have seen these stories, but it's kind of interesting as folks all these employment benefits are starting to fade in the background in a lot of states. The rumor is that people are quitting their jobs, and I mentioned this, I think, in a video a few nights ago, that people are starting to leave their jobs. So we're going to see some really, I think the rest of this year is going to be a lot more volatile, and it's not going to be all one-sided, not just up. I know the meme, stocks only go up. I know that, but they don't actually. They do have periods where they go down, and I'm not ready to call that yet. But we are getting to the point where there are some things that are happening on a short-term level that are going. You know, I've talked a lot. If you watch my videos every night, then you know I've been talking about how our database just isn't getting any traction. So, but this 10-year note is in this bottoming phase. We've got this upward slope. We're in that trend maintenance mode. If you've been around the channel for a while, I won't go and teach that again today, but the indicators that you see here, the price pressure momentum, they are not about divergence. They're about output. So we do have a pretty negative weekly ppm right now, a 0.81 on this. So that number right now, let me put that up on screen here, 1 second. At 182 is the 10-week moving average. That ppm1 is tracking the 10-week moving average. So it's sandwiched right now between a ppm1 at a minus 0.79 and a ppm2 with a positive 0.84. And we're getting a crossover of the 10 and 21 period moving average. And when that happens, we should see, let's see here, I believe next week we're going to get that cross. And a lot of folks look when this short term crosses the intermediate that's a negative. I always see that as the point where this is the bottoming phase on a longer term. So because of the 40 period moving average underneath this, the absolute worst case, like I said, is about 138 on these things. So I'm trying to get to a point here. And so what we should see in these ppms over the next couple of weeks, this is intermediate viewpoint, is we should start to see some stabilization, and yields should stay above 138, stay below 160, no matter what happens, probably 155, and then we're going to set up this next pattern, which I'm going to show you on the monthly chart. So on a monthly chart, this thing is crazy. Since this is an inverse and we're looking at yields here, this is a really bullish chart, which means ultimately yields are going to go up. I'm going to put on, I developed a Fibonacci tool. It does its pattern recognition and actually projects the patterns out in the future. I'm going to bring that up in a minute just to show you some of the things that are out there. And I'm going to backtrack a little bit, go from monthly back to weekly, so you can have exactly what's going on. So let's do the let's put that Fibonacci on there. So there's a couple overlapping, but I want to show you this real quick. Is the projection for, there's a kind of a commingled numbers here, 2.29, or let's just call it 230. 230, between 218 and 230 is likely where we're going, and the 40-month moving average is up at 2.78. It is declining at a pretty decent rate. So there is a cap on these markets, but I think we're going to see 190, ultimately probably 210, 230 range up in there. And that's only going to happen, I believe, is if the inflation expectations that I showed you on those charts start to change a little bit, the 1 year accelerates, and maybe the 10-year outlook and the 10-year swaps start to price in maybe a little hotter number than what they are right now. But it is, as I showed you, consensus on a short-term 1 year outlook is 3.6, and on a 10-year it's 2.45. So it's right at 2.5. And so I think those numbers are going to get blown up as we go forward. And I still think it's too early to make a call on this transitory inflation. I think it's going to be September, October. By then we're going to go, aha, we got it. So, stay tuned in. So what we're looking at, let's go to the yield curve, because this has been really dramatic over the last week. The Fed has come in and bought the crap out of the 10-year. So they tell you they're buying $120 billion of securities. They don't tell you which ones, right? And the ones that they're buying has obviously been the 10s and the 30s. So you look at the 10-30 spread has just collapsed. The 5-30 spread has also collapsed. So they're buying 5s and they're buying 10s. And the other there's a couple other international buyers. The Japanese, I believe, are buying across the board. I actually deleted that chart. I wish I'd have left it up there now. But there's a lot of buying going on in the short-term securities, and especially, like I said, here 5 and 30. That's both on the screen here, and this is by design. And I follow Jim Rickard on Twitter, and he's talking about deflation and all that stuff. He's starting to sound a little crazy, like Kathy's casino girl, Kathy Wood. Is that there's some this big deflationary, this innovation deflation thing going down, and I don't think that's going to be the case. Maybe 5 years from now, but not right now. There's going to be further influences with all this money and the borrowing in the future and leveraging of the economy, and I don't think the Fed's going to back off that in any way at all. That's just not going to happen. So, all right, I think I've unpacked a lot of that. Let me just look at one last thing here. Yeah, so let me see what you folks are saying. All right, Robert Kelly. That's not true. The only people I block are people that called me a crook. I block you guys immediately. So that's okay. And you have anything better to do? You know what? The markets, I have to address trolls like you because that's not true at all. You don't know me at all. Okay? So, it's a typical internet thing. Anyway, yeah, Christoph, you're right about, he is a doom and gloomer. So anyway, yeah, I don't mind. You can disagree with me, please do. I think the disagreement is the best thing that happens. It's called communication, and actually, trying to come up with opposing views is good because sometimes you have a good view. So feel free to state it. Okay. Yeah, Antonio, I agree, but everybody's adopted this. It's like on certain health issues, it's a universal adoption of I guess there's script. It's almost a cut and paste script of everything. And right now the central bankers, I mean, these guys, they've got a club, so they're just hanging out and everybody's doing the same thing, and they're looking at Japan. Yeah, dead economy forever and the whole bit. So anyway. Okay, let me just see if there's anything else going on. Yeah, they're not, Michael Bergen, they're not getting under my skin. I just like to get in there and come back at them, so it's all good. So let's see here. Yeah, so all right, so let's move on. Let's get to the indices. Let's start talking about what's going on with the equity markets and start to talk about maybe forecasting a little bit ahead of things a little bit here. And so let's go over and start looking at some of these other metrics out here. I'll go full screen so we get a better view here. Yeah, I'm going to show you something here that just coming up. I mentioned we've had some cycles come into play on the S&P, and we've had this I mean, this market is really flat. I mean, if we went all the way back into April, you know, we were printing right around 4,200. We had a couple peaks above, but we've been 4150. Now we're printing up at the almost 43. So we've managed to creep up this last, we'll call it last 7 or 8 sessions, right? We've managed to creep up there. We are finally seeing a little bit of acceleration on PPM1 here on the screen. I just put a cursor by it down here. It's at 0.16, 0.10 on PPM2 and PPM3. So they're trying to turn up. I talked about some of these elements that are out there as far as cycles coming in. We had multiple cycle events happen, and that's interesting only because the way that these high and lows are being configured here are suggesting that there's going to be a lot of little mini cycles, which I don't think mean much. So there's a lot of noise in the markets right now, and I think it's just the uncertainty of everything that goes on, because it's really it's really about the uncertainty of infrastructure deal, taxes, everything that's out there. So I told you folks, and it's interesting because on the channel, people think I'm getting political. My job is to look at what the government does and try to figure out what the effects are to the market. It doesn't matter who it is. I did it when Trump was in. And you know, it's like some people don't like you criticizing, and it's not even criticism, it's a judgment of what I believe is going on. And that's this market right here. When you look at this flat kind of climbing the wall of worry, that's exactly what the market's telling you. They don't have a clue, and there's a lot of uncertainty. So there's nothing to say something's bad, and there's nothing to say everything's super good. So you get this, and you get this low momentum, you get this crud, and you try to make decisions. And one of the things, and I'll bring that up in a minute, is on our database, you know, we track 16,400 symbols, and we're just not getting any traction at these all-time highs. And I've seen this party many times. I've been watching his database for over 22 years now, as far as the daily output of our software. We've had the software on the market technically since 1996. So it's really, you know, it's just part of who I am, and it does a lot for me for short-term analysis, and the intermediate trends still are very intact. We'll go through that in a minute. But we're seeing some acceleration here. There is some Fibonacci numbers embedded here. 4308 is a really, I don't know if I can blow this up or not, but let's see if I can. I'm going to attempt to do something. Yeah, it didn't work real good, but you can see there's a little red dot up here, and that little red dot is where this number is. So there's a yellow dot in there, 4287, and then 4308 is the other one. So yeah, that's hang on one second. Yeah, so there's not really anything there. I'm going to take the Fibonacci tool. No, I'll leave it on for right now. But there is some very tight 4308 is going to be some pretty major resistance. We get above that and possibly can go higher. I'm going to look at the weekly chart next. Let's go ahead and do that. And I've talked about these numbers before. There were some numbers that were being projected for 4605 for a target. If you notice these dots up at the top of this chart, this is when this, on 10/23 of last year, if you go back on the channel and look around this date, you'll see a video I did one day, new Fibonacci projections revealed. And this is what I was talking about back last October, that we're looking at 4605, and that seemed pretty far-fetched. At the time when that came out, the markets were 3,400, 3,500. So we've continued to move up, but now there's been a moderation, and this happens a lot with this tool. There's some new dot, we'll call them the WaveTech dot plots, right? So the new ones are suggesting 4571, 4768, 4889. But go back to the old ones, they were 4605. So I even argue that we're looking at 4571, 4605 would be a minimum target of this market. And we still have positive PPMs. As we look at the PPMs on this page, what you'll see is that they're all very positive. You have 0.27, anything over 0.25 is trend mode. So a positive 0.25 is an uptrend, positive 0.47, and a positive 0.65. So all three of those levels, and I've talked to you folks about this in the past, but what happens here is I talk a lot about the angle of attack, and the angle of attack is these moving averages here. Just draw them out. So they won't go into perpetual like a trend line. The thing I have issues with drawing trend lines on charts because they're static and that I drew them. So what's happening here is this is why I like moving averages, because I want it to be a mathematical calculation rather than something that I grabbed, a couple points off a top of a chart and go, oh, look, that means something. I don't think it does, in my opinion. So, but what we're looking at here, and I've talked a lot about this in the past, is that these indicators get into trend mode. And this is a very long trend that we're in. And we're finally getting to the stages. I believe there's one more high in this pattern. We should get up into these numbers somewhere. Probably the 4,600 level ultimately will be where we'll head to. But we're going to climb along these inclines, which are all in trend mode. Now, we start to see, we've already seen some deviation, but this is pretty standard. And I'm just going to put this out here. I said I wasn't going to do this earlier, but I'm just going to bring it in very quickly. Is what these indicators do. I always talk about momentum precedes price. So we get the momentum spikes here, and these are all different length moving averages. So the first one, this one here is a 10-week moving average, 21 simple and 40 simple. So what these do is we get into this mode where we get momentum, and then you come in, and then this here is what I talk about is the trend, maintenance mode. So somebody would argue it's got a divergence. Well, if that's the case, and this was the first divergence was way over here, and there should have been a top, but that's not how these work. These are a measurement of output or angle, as I said, angle of attack. It actually came from an aviation theory of wing lift, actually, and it actually applies very well to the markets. I'm working on a small class that I'm putting together to show you how to use these PPMs, and I'm working on an offering for the PPMs on TrendView. So So that's still being worked on. There's a complication which is out of my control at the moment, but it's being worked on. But these indicators, actually, what they're doing is they're just telling us that these three lines, these are the trend line, the 21-week moving average is what I call the primary demand line, and until we cross back over that, we're going to continue to climb up that line. Even if we got through the 10-period moving average, it would not be that wouldn't be that devastating to the trend. So this line here and this line here are the longer term trends. And because this is a weekly chart, it takes a while for this to bleed off. So we're still in this uptrend. This thing is not over. And whether we get a move down to the 21, that's right now, that's not even a big deal anymore, right? It's down to 40.95, and that's rising every week by 20 handles, so it's 4,100. Next week, we've already printed down to, this 41.73 was the low last week. Hang on. So we've already been down there, and we're just going to continue, like I said, to climb these lines. So let's do monthly, then I want to go to a quarterly, and then we'll cover some of the other indexes. So this monthly chart is really interesting. We've got PPMs at a plus 2.12, 1.86, and 1.28. And way back, it's interesting. The long-term demand line is right here. In 2016, we traded down just below the 40-week moving average. We got down to 1812. We got to 1849, and that was it. We traded just below it again in 2018 in that fourth quarter debacle, and then we spiked below it, and then literally the next month we were right back above it, and now we're in this trend. And this has everything to do, if you've been around since the beginning of this broadcast, is with the spending and the pumping of the money of the Fed, borrowing from the future to make these markets move higher. And that's why that debt ratio on a worldwide level is up at 365, 370% versus average GDP. So we're looking at some very, very big numbers, and there's no signs of this thing starting to really roll over because we've got this big number up here. We're looking at 212. What that tells us, it's not in play right now, 38.18. We're looking at almost 100 points per month. So literally tomorrow, that's going to be 39, around 3,900, a little bit above that when this gets recalculated tomorrow. And these numbers are going to continue. Same concept, the angle of attack is in play here. And we're at the beginning, we're at this beginning phase of the market trend. We're about to go into trend maintenance mode. So we're looking at still, it's hard to say, but we're looking at a potentially still a multi-year pattern. This could carry us in through 22, 23. And I'm trying to get some more stats on some things, but it looks to me like the infrastructure deal is a joke. There's very little potential in that infrastructure deal to do it, but what it is going to affect is the market sentiment. It is going to affect how the Fed and cash flows in the economy, other things are going to happen. So it's going to be interesting, and this chart is just telling us we're a long ways off. Okay, so now we're going to go, let's go over to this chart, which is on TradingView, and these are the PPMs, PPM 1, 2, and 3 on this chart. And I want to discuss this. So this chart is very long term, and that is the this chart goes back to the lows in 1933, and there's a wave count on here, and this is a quarterly, so each bar on this chart is 3 months. So as we look at this, it's very interesting, and I know you folks, you'll have to trust that what I'm telling you is true. There's a couple things on this chart I think are significant to point out, and especially from basically, if you're familiar with Elliott wave at all, this would be a grand supercycle viewpoint, and this is interesting because this chart actually can go back to like 1877. So it's a very interesting long-term chart. But there's a couple of things I want to show you here. If you know a little bit about Elliott wave, there's something called the rule of alternation, and typically what we'll get is you get a complex ABCX, ABCD, or an ABCDE triangle. Something sets up here, and it's very complex. Takes a fair amount of time to unfold. In this last situation here, and this goes back to the 2009 low, I remember, and I wrote about this, is that this is possibly a fourth wave low, and that there's a whole nother sequence up, which here we are, that is happening. And this sequence is not done yet. It's interesting because I'm just going to draw some stuff in on this chart so I can reference this. There was a lot of things happening, and I'm drawing these reasonably accurate. But all of these indicators kind of came to a point in this cluster here where we started this correctional phase where they were starting to roll over. Let me clean this up so you can see this. And right at these points here is where the indicators were starting to roll over. Now this is quarterly chart, right? So somewhere right around this high is where these things started to happen in sequence. What we're seeing now is something completely different, is we're actually seeing an acceleration of all three at the same time. And what's possibly going to happen, and I'm going to get, every once in a while I get into this, we'll call it mad scientist mode, but I'm also getting into extrapolating out what this possibly means for the future. So it's going to sound the opposite of Peter Schiff, the opposite of Harry Dent, the opposite of any perma bear. I'm going to sound like a perma bull at this moment, because these indicators are telling us that we're likely to peak out and then get into that trend maintenance mode. Let me just try to draw this in. And this same configuration would happen on all of these as I draw these in. And you would just get into this peak and sideways. And what that tells us is that there's a very long-term trend going on. I just talked to you about the angle of attack, right? The angle of attack on a quarterly basis is insane. And if you go back to 1933, I'm gonna go a little deeper here, folks, because this is good stuff. Here's that same formation that I talked about way back in 1933. Increase, down, trend maintenance mode. Okay, we'll call the trend maintenance mode into right here. So that trend was from roughly 1939, 1940. It's kind of hard to tell on a scale. I can't bring up the cursor right now. All the way into the 1973, 74 bear market, into that correction. That's what you're seeing now. One of my mentors started in the markets in 1969. Literally, he used to always tell me, at the worst time you could have started being a stockbroker that was possible, right? There was no, you couldn't have started at a worse time. And it was right into this bear market. And there was a phenomena that happened in around 1974 through 1976 as this low was happening. I just know this from Frank, my mentor. He's left us a while back. And what I know is interesting is he found, he was a big book value guy. He looked at where the stock was trading, and it was like there was so much value. His claim to fame from 1974 to 1980, 81, every $10,000 invested with him and what he was doing turned into $1 million. Okay? So we're talking basically a 7-8 year period. We nicknamed him, we called him the professor, and you know, he always talks about looking at these long-term values and all this stuff, and that was my primary influence when he told me that story. And I seen it. I knew a lot of his clients. He was a good friend until he died, and you know, so it was like an amazing. He went. After that, he made so much money, he left the brokerage business and just traded for himself and a couple of very good friends that he had made a lot of money. They continued to work together over the years. And so this was, but these values happen. And what I'm seeing here now again is this grand super cycle is extending, okay? This quarterly chart that we have here, where I've got wave 5 of 5 set up, but I think we're still in 3 of 5. So I didn't break it down. I need to put in the wave count here, but I think we're about to finish possibly wave 3, which is probably that 4,600. And then we go into a corrective phase, and then there's more, okay? And depending on how and where you measure this thing from, it's going to be very interesting. And some of the metrics, and if you do Elliott Wave the right way, there's a lot of folks that I don't think ever read Ralph Elliott's theory and have expanded upon it. Maybe that's appropriate over time. But there's a lot of new theories within Elliott Wave, which I would argue with if we were getting into a debate over, especially the ABCD formations that a lot of people are using. Was never written about, never was a thing. But the point of this is that there is this extended pattern happening. It looks like it's going to continue, and at least it looks like, it's hard to say how many more quarters, but this acceleration in these PPMs is another reset of this long-term trend. And you have to argue we've been in this trend since 1933. And, you know, maybe all of this stuff and the spending and everything we're seeing, everything from the Green New Deal and all this stuff, a lot of folks want to push back against it. I'm not necessarily pushing back against it. Anybody that's in Asia or been in other, you know, have seen what new innovation and what new cities look like and act like, and especially on crime levels, right? You come to America, it's like the old West and everything's old. You know, you're expecting to see steam engines running around this country. You know, it's very, it needs a lot of updating. We do need high-speed rails. We do need that stuff. You know, we need all of that. It just seems that there's so much politics involved in everything, you can't get it done. We'll see. But these are long-term good things for potentially for America. So I am. So those of you that think I'm just pushing back on Joe Biden, I'm not. I see some good out of this stuff. It's just a matter of, you know, when the government gets mixed up in some of these programs, they don't go as planned very often. But they have in the past, so we'll see what happens, right? But this chart is telling us that there's a long-term trend here that is going to continue on. And this, you know, there is going to be, somebody made a comment I saw earlier that there's potentially a, third quarter, maybe we start some little correction. That can happen within the context of what I'm talking about when you're looking at these long-term charts. And like I said, I think we're close. I think we'll probably print into that 45, maybe 46 handle. That at that point, you'll probably start to hear me talk a little bit more about some correction. It doesn't look like it. I remember when everybody was screaming, go in May, sell in May and go away. We got a little blip in May, and it's been straight up ever since, right? So we're at all-time new highs, and that's the way things are going. Yeah, and I see Wave Runner. I just happened to glance up and see that inflated balance sheet is super market positive, and that's what, if you go back to the beginning of the show, that's what I'm telling you. They're borrowing and leveraging everything, and the equity markets are the place to offset this. And that's probably why a lot of people, somebody made a point up, as long as you can make money in stocks, why would you go back to work? And the answer is you wouldn't. Yeah, thanks. Exactly. And listen, you guys know where I'm coming on this thing. I think all these things need to be done. America is, I mean, I'm almost, I'll be, my birthday's coming up. I'll be 69 years old soon. And I've seen a lot of this stuff. And I can tell you, I look at our cities, I look at everything, and then I look over at Asia, and, I won't mention the countries. But even look at Panama City, Panama. I mean, it looks like Asia. What's going on down there? So it's one of these things where America needs a lot of remodeling. And those of you in Europe, that's even more so there. All the cities are old. There's a lot of old infrastructure. Just, the West is stuck in this crazy, they're just stuck. It's like quicksand, right? Jay knows, my son's on here. And I told all my kids, move out of your hometown. Don't live, I left my hometown where I grew up. And it was the best thing ever happened. Make your world bigger, get out of it and see a different place in the world, and that if you get around the world a little bit, you'll know what I'm talking about is true. Yeah, I know they did. And that's why it looks like that, Christoph. They did. Listen, they're about to update the Panama Canal to the point where it can take the big, Jay and I were joking, Star Wars analogy, big Corellian ships can go through there. And they're going to be able to bring the big containers through there. I think it's next year. When they do that, every boat from China that's going to Europe is going there, a lot of them. It's going to really increase a lot of stuff. Yeah, Red Rocker, you're right. Jim Rogers, there's another guy that used to come on. Dennis Gartman. That guy hasn't been, I met Dennis way back in the late 80s at a conference once. That guy hasn't been right about anything, and they used to bring him on Bloomberg and all these shows like he's some kind of expert, and I don't know how he exists anyway. It's amazing. He's right up there with Peter Schiff, right? Like what is it with these folks? Yeah, hey, thanks for pre-happy birthday. So my birthday's August 2nd, so you guys can send me presents, like subscribe. We're almost at 30,000, so do that if you haven't already subscribed. Do that. That would be that's a good enough present for me. So you guys get where I'm coming from on this long-term viewpoint of the markets and the way that capital's moving right now. So we're going to see how deep am I? Pretty deep. Not too bad. Hour in. This is pretty typical of these streams when I get into these things. I want to go through. We're going to look at the NASDAQ and a couple other elements, and then we'll be able to. I'll be able to take all the stuff I'm talking about, cash flow and other things, and forward think that. I think that. So let's do that. Let's go back over to TradeStation here, and let's put the NASDAQ. It's interesting. We're right at the end of the month. I'll just leave this on the monthly right now. The market grid. Hang on. The market grid for the month of June, RXT 14,686. We're at 14,598, so we're almost at an RXT level. So those of you, if you're new to the channel, I built a indicator, which you see, it's on all my charts, is actually showing you what the expectations for each period, whether it's a monthly, weekly, even down to a 5-minute chart, it will do it. And what we're seeing here is we're at the extreme projection for the month, and we're also at very robust PPM numbers here in monthly, and PPM2 is accelerating yet. And so once again, I just want to point this out because it's part of the overall commentary that I'm putting out there. Is this? Look at these angle of attacks. So you can start. We're just looking at a monthly graph. I know we're looking at S&P, but we look at this. These projections and these angle of attacks are just absolutely, they're going to sustain themselves 4 months on end. These are monthly bars. It takes, 8, 10, 12 plus bars to even start to really make a material change in the momentum. And that angle of attack right now says there's only less than a 10% probability that we're going to decline below the 10-month moving average, which is basically nil, right? You can make a bet if you saw anything close. I talked about that number going back in March. The 10-pair moving average, 11,943. The low was 12,186. We got close, and at that time, I remember the 40-week moving average. Let's just go there. Yeah, the 40-week moving average was 18,818. So we came right in here, but we hovered along that demand line I talked to you about a minute ago, is the 21-period moving average. A lot of folks, I know a lot of you newer traders and this stuff's been around for a long time, but using exponential and weighted moving averages, and I don't like them. I just want the simple moving average. The reason why I did the simple moving averages was identifying patterns. It had nothing. We were more, wave tech is the combination of moving averages and Elliott wave to confirm wave counts. So when we were doing that, the simple averages just worked. We had availability at the time of doing, exponential, different kind of weightings. We had all that. Even back in the old days, in the 80s, we could do that. And so the point is here is that, that 40 was the primary support line, but the primary demand line is running right through the middle of this. I don't think we ever closed under the 21-week moving average during that period of time. We just continued to climb. And if we look at the projections right now, let's do that while we're here. The min projection, 14,771. Next level will be between 15,400 and 15,900, rounding numbers off. And that is that recalculation. If you remember, we were going through the S&P back in October, the new Fibonacci projections were suggesting up at 16,485. Those got recalced again to high target 15. These are the men's 15,145. You can see the numbers on the screen here. And then they've been recalced recently of the last month. And now the number's 1471, 15,854. So some of these numbers end up to be similar. The previous 15,145 to 15,484 would be your most likely range now. And then if you look at the next level on this stuff, you get a little bit between there's a cluster of numbers. If you've been around the channel, you know I like cluster, and they're close, right? So we've got the extreme 15,925, the middle number of the previous calculation at 16,275, and then we go to the lowest level of the original projection that came out of the patterns out of last October, and I would argue that they're still valid, at least at minimum 16,485. So if you were asking me, and you are, what's the expectation on the extreme range? It'd be 15,925 to 16,485. So we'll call it 16,500. So there's a big cluster of numbers moving toward that level. And as long as the Fed's going to print money and keep doing what they're doing, which they are going to, these markets are going to keep moving. And I didn't really go into a deep dive on employment situation, but the employment situation is also, I think, is going to deteriorate, whether it's people not wanting to go back to their offices and looking for new jobs, looking for jobs that they can work from home, or whatever happens. I still think there's going to be challenges in getting traction in the economy and fulfilling those 9.1 plus million jobs that exist out there waiting for someone to come to them. A lot of those jobs are still in hospitality. We know TSA is short. We know the airlines are short. Everybody's short. And on the reopening trade, folks are going to have to find a reason to go back. And if you figured out something, maybe from slinging suitcases on a trolley, you found a better job that replaced that, you're probably not going back to that. But somebody's going to want that job eventually, right? So they will come back. I just think there's going to be a further lag in the economy. But these numbers on the indicators are substantial in my viewpoint as far as moving toward some of these targets I just discussed. Okay, let's do Russell. This is somewhat interesting. I noticed this the other night. Sometimes I'll cover it on the videos. The daily videos are a lot more work than you people probably think. I don't know what you think, but it takes a lot of discipline to show up every day. And sometimes I just briefly touch on things and get through it and move on, especially in markets where we're doing this. But here's something interesting on this chart here, I think, that I'm going to go full screen so you can get a really good view of it, is that there's some new Fibonacci projections here that are in play, and they are for the NASDAQ to go to 3,000, 33, 62, 35, 72. Now, they've been in play for the last couple of weeks, and as these numbers go, they take a while to set up. So if we go way back, this is the October numbers, right? Those numbers were 2,069, 2313, 2463. We got to the high in this range right here at, that was high was 2360. So we got 2313. So we rose just a bit above that middle target. We went between target 2 and target 3. So typically what I would tell you is the minimum target 3,022, and what this target is based upon is the patterns that it's being recognized as. This is where a 1 and 3 or an A and C are equal in length. So this is the equal length. The next number is 1.382 times that length of that pattern that it's recognized. And then the final one is 1.618 times that. So this indicator automatically does that stuff, so it makes it really easy. And I don't put this up very often. Let me see if I can put it up. Hang on. Sorry to bore you with this. Hopefully it'll be worth it. So I'm going to put both of these on. This is what's working inside is a couple things here. There's a red line that's recognizing the big patterns. There's the white line is recognizing the shorter term patterns. And these are used for calculations within our trading systems. They're used in calculations for the targets of a market grid. So this thing here is these indicators here are being calculated off of that indicator. Now my intentions are for this indicator, the Fibonacci projection and the cycle tool are going to be public domain on TradingView when I get this thing done. Okay, so I will keep you informed when those things are happening. But you can see at least where those numbers are coming from. So we'll leave them on there. Maybe we'll have some fun with those. The final chart that I want to look at is the Russell versus the NASDAQ. And I've been talking to you about this for a number of months. And just to kind of recap, at least my memory of things that have occurred, going back to last year, September, October, I told you that the Russell was going to outperform. And then over the last couple months, I told you that we were going to have resistance around here. And this pattern would probably end up to look like this. And this level here is going to be the key level. So we're down to the major support. Let me, I got to do two things I meant to do before we did that. So this was expectations for the Russell to outperform. It peaked out. I do remember in February I started to scream this area right here is going to be the extreme. I believe at this time the NASDAQ was up about 18% on the year, and I'm sorry, the Russell was up about 18% and the NASDAQ was up too. Now I mentioned in last night's video, we've almost normalized everything because we have right now the S&P as of yesterday's close was up 14.3, NASDAQ up 12.7, and the Russell up 16.9. So we're basically the Russell still has a slight edge, but not a lot. And if we come back down to probably about here on the spread, this is where the Russell will be, and the NASDAQ will ultimately be very similar in returns. And that doesn't mean that the NASDAQ or the Russell has to go down to make that happen. They both could go up. Just NASDAQ just goes up faster, and that's what's been happening lately. The markets are all generally floating higher no matter what the indice, but the NASDAQ has taken back that leadership. And I've talked about this as well, is that we've had a substantial amount of contraction when it comes to the breadth in the market or the number of stocks participating. Okay, so I am just very quickly here, I'm going to go over to our WaveTech and Portfolio Expert platform, and I just want to show you something here, is that I'm going to zoom in on this, okay? So what you'll see here is that the intermediate models are 72.92% long. So there's 11,953 symbols that are currently have open positions out of our 16,391. That is pretty bullish. The percent, I'll bring this over a little bit. I think I can do this. Hang on. If you look at this table over on the right, you'll see that the optimized weekly, so this is on all the models, there's a bunch of stats here, but one of the stats I want to point out is that right now the duration of the holding, the average holding of these signals. So one of the things we know, and this is what drives this channel, is that we know what the average holding, what the average returns are, and we know it on an individual symbol by symbol basis on all 16,400, and we also have a composite viewpoint, which is what this dashboard shows you. And that dashboard will tell you a lot about the metrics of the markets, and I'm going to go through the daily here in a second, but this puts everything we just talked about on the indices and everything together for what the expectations are going forward. And also going back to an hour and change ago when I was talking about some of the things that are concerning right now. But this intermediate database is about 50% through its cycle. The one thing it has done, the profit fulfilled over here, see where my cursor is at 70%. That was up at 90, so we've seen some rotation. What that means is we've seen some new buys and some old buys. We've seen some exits of some trades and some new entries and refreshing the database. And a lot of times during a market cycle, we'll see this thing, actually in this market cycle going back to, let's say, August, after the June lows, going back to September and beyond, we've seen the short-term database actually refresh 5 times during one cycle of the intermediate. So the short-term cycles run about 30 to 45 days, and the intermediate cycles run closer to 200 days, the better part of a year. So what I'm able to do is to get a feel for those cycles as they're happening on each one. So hopefully that makes gives you some context of where I'm coming from when we're looking at. Excuse me one second. I gotta turn my camera on. Okay. Yeah. So that's a perspective of what's going on when we look at the. I'll just leave this on big screen just so you can see it. Look at the dailies. They're at 35.33% bullish. A 42 number is kind of a minimum for a trend that's sustainable. We can't get over, we printed over 42, 45 a couple of weeks ago. We collapsed back into 28%. Now we're back at 35. So we're just kind of grinding and changing hands here. And that reflects, if you were been watching this for a while, what I talked about early in the broadcast is that along going all the way back to March to current, we basically have been in this sideways mode. And when you get, and that's why this is not getting a lot of traction. And a lot of stocks, what that means is there's a lot of symbols that are still recycling, setting up bottoming patterns, but are still not in a place to get a correction. I would like to personally see like a move back into mid 4100 or something like that, and then stay down there, not just buy the dip, snap it back, but actually grind it out in the mid 4100, maybe even print 4100. I thought that was going to happen a couple of weeks ago. We got the dip. The futures traded down to 41.25 and shot back into 42 handle. That was over, and now we're 43. But if we could see 41.80 and then 41.40 and then grind that out, that would give the opportunity for this database and all these symbols to kind of reconfigure themselves. So if you could picture, this is the world that I live in, and how I see the world is that when the markets are when the markets trade down like that, you get all the steep declines, you get all the stocks to refresh, set up nice bottoming patterns, and that's what we're going to pick up on. The software is going to pick up on all of those patterns and the emergence of new trends on a short-term basis, and that tells us the database has been refreshed and it's going on. When we look at intermediate, most intermediate trades came on back in September, October, and in November. There was a lot of stuff. I remember proclaiming on one of my videos that the easy money was done and it was going to get a lot harder going forward, and that was in December and January, and it has done just that. It's gotten a lot harder to try to make money, but there's still some really, really good stuff out there. There's Jay and I were going through some of the portfolios that I have built on our platform here, and I took all the meme stocks and threw into a chart, and that this is the green line is the graph of that. It's up 374%, trading 10 symbols, and they're all the meme stocks. They're AMC, Bed Bath & Beyond, GameStop, iRobot, all the one. And I didn't even update this. There's other symbols that the Reddit crowd had put on there. But I just grabbed these. I mean, I thought on this spike that I told Jay that on this first spike that all we're going to do is spend. We're going to spend the let me just go back 1 year here. There you go. So you can get a better view of that chart. I thought when that first spike in the middle of the chart, when that happened, I thought we'd just give the rest of the money back because there was a big spike. GME traded down, everything traded down, consolidated, and then we get another run, and a lot of that run was AMC, right? So I think the last buy in AMC was like at $10. So the point, and the little blue line down at the bottom is the S&P 500. So, but the point of this is that's there's still some things out there. I have a thing called VPM Select. This portfolio is something I built almost 5 years ago, and it's a select symbols. They were actually selected from the S&P 500, and there's actually not many of there's not a lot of FANG stocks in this. It's all pretty mainstream if I were to show you the actual symbols in here, and it's up 77% this year. So there's just a lot of stuff. I think we built a while back, we built a live stream portfolio. I did one day, and that one's up 57. So there's a lot of even just trading Roku, we're up 30% trading Roku, doing a multivariant. But anyway, the point of this is that there's still a lot of opportunities, but you've got to be really super selective on as far as things go, because the selection process is everything. It's always been everything. Last year was what I call as a dartboard market. Just throw a bunch of darts out and buy whatever it hits. Everything was depressed. Everything, literally the Great Reset was done stock market collapsed, everything was cheap, anything that was viable, you know the rest of the story. Now you've got to actually figure out things. And a theme that I had put out there, which I was not able to really put together very well, was I mentioned, I think in a couple of videos ago, I was going to talk about maybe some of these direct to market, like what Nike did to expand their earnings. And that's not a new model by any means, but I'm still looking for folks. If I'm just going to solicit, I always call you guys are my army. So if you have ideas of companies that you think could be a direct to market, like a Nike, where they just do an end around the locker box, you know, all the different big box stores, and just go directly to the market. I mean, I think like Dollar Shave Club and Henry's and those kind of deals, they've all been bought out by the big guys now, I think. I mean, they were great ideas. And then I think Gillette or somebody bought one of those guys. And now they're doing this. They have the same subscription model. I was at the drugstore buying some stuff, and I saw I think it's Henry's, you know, you could buy their razors in the store now. So they went from direct to the store. So yeah, I agree with the slave. Exactly, slave labor. Only from the University of Oregon could you get that. Yeah, Steve, I don't think there's a 10 or 15% market correction, although, especially over the next 2 months. I know, hey, listen, that stuff sells, right? Harry Dent's been selling letters for 10 years saying the market's going to collapse. You know, Bob Prechter did the same thing with Elliott Wave International. He was constantly telling you, you know, that market was going to zero. And what's that? I'm just yeah. So yeah, I think I covered those expectations. Like I said, I would love to see a 41 handle or something. I'd like to see the market reset. The metrics I'm seeing right now don't reflect that. Maybe over the next couple of weeks that'll come into play, you know, and I'm going to go with it. I'm not bashful. We start to see metrics roll over, especially on the intermediate models and those things. I will definitely be on that for sure. Okay. All right. I'm just looking at what you guys are chatting about. Oh, Mr. Tater, your APPH, is it moving yet? Not sure I know Martin Armstrong. Let's see here. Just a couple of things. Yeah, so let's get into, it's 12:04. This next hour will go pretty fast. It's amazing how fast things do go, especially when you have a good can of Runa. I'm not getting paid. Matter of fact, that was the empty one. Yeah, so let's do this. Let's run through. We did a big story on interest rates today. Let's take a look at the dollar, because I think there's some interesting things going on there as well. I've talked to you folks about the dollar. Let me just bring that up while I'm talking. So this is the dollar weekly. We're starting to see some really big metrics come out of this. This is starting to look like we're going to challenge 94 handle, 82. I think gold's going to hate that idea, although it doesn't care about the Dow today. It did yesterday, but and I'm going to go through the Dow and then gold, and then we'll hit the cryptos and try to get back on cycle. You know, I get into these long conversations. I wish there were people. I wish I could hear you guys and we could talk. I did something like that once where we did a call in basically through Zoom. But that would make it really, really fun. I still, I looked at Discord and some other stuff, and I just didn't like the format as well. Maybe I'm wrong about that. But if we look at the Dow, we've got, this 200 week moving average is actually got a very positive slope on the PPM. It tells me we're going to reach that number. That's 94.80. We're trading 92.40, so that's 2 handles more on the Dow. And we got right into some of these Fibonacci downside projections. Now we have 3 upside projections. Let me put that on screen for you here. Here's the projections, Fibonacci projections for the Dow. 93.30, 94.74, 95.62. The high target 2 and the 200-week moving average are virtually the same number. 94.74 and is the target. The 200-day is 94.82. So I think that's where we're heading on this thing. And the upslope of these averages, I talked to you several weeks ago. There was a key number, 89.29, I think was the right number, 89.27 maybe. But if we held that number and we were able to get back over these averages, which we have done, then we were going to head at least to this 200-day. And we're going to go to monthly here and just take a look at that. This is a number, I saw this the other day. The monthly projections, this is crazy. Sometimes, there was a passage in something I read in R.N. Elliott's, the original works book, not the Bob Prechter written books, but there was if you see that book, it's actually a decent read. It was Ralph Elliott's original writings that he did. And one of the things that he said that I thought was in one of his essays that he did back in the day is that the hardest thing you're going to have to do is believe what you're seeing and what the theory's telling you. That's going to be the hard part. And so I've done a lot of those hard parts today, and I'm sure at some stage some of this stuff will age well, some of it won't. But it's talking about what the theory is, what the probabilities are, and those type of things. And anybody, if you go back and watch my October videos telling you about 4,600, we're 43, we're pretty close. That was from 3,500. So we're getting there, and these numbers just play out. They take time. I've told you the story before, back when I was trading on the Pacific Options Exchange as a floor trader. That guys used to always try to nail me down. I had a nickname called Dr. Given. And given was, hey, it's just going there. Like I'm telling you, it's a given this thing's going to the 200-week moving average at 94.80. And they'd always catch me, well, when's it going to do it, smartass? When is that going to happen? And I go, and so I'd be forced, okay, by year end. And of course, it would happen in February, and somebody would claim I was wrong because I said it was going to happen by year end. But the timing of these events are hard, but the projections, if you're willing to be patient and watch and just make sure nothing's negating those patterns, and that's what we're going. And that's what I look for. Everything that I've talked to you folks about are in my mind. I had a guy who used to work for me. He had the worst. He was 30-something-year-old guy had the worst memory of anybody I've ever met. You know why? Because he used his phone. He never memorized anything. He stored everything, and he had to have that phone. When I started in the markets, you had to have everything here. There weren't any handheld devices in 1979, 1980, so you had to retain all these numbers. I can tell you that I believe the contract low in 1980 of the 30-year Treasury futures was 54.17. That number's stuck in my head. So, you know, those are the kind of things that you did. And we used to have to calculate our average positions and know where the numbers are. There's another great book. I'll give you another book idea. It's called Metal Men. And it's about, what's his name? Not Rich Paul. I'm trying to think of his last name. I'll think of it in a minute. But he was the guy that, his last name was Rich, okay? And was it Paul Rich? He was the guy, he was an Israeli that actually is in this book called Metal Men, and Bill Clinton pardoned him in 1999. And very interesting read, and it talks a lot about trading. There's some really good stuff. So that's a good trading book to read if you want to read. I think that book was probably written, I'm going to say maybe in the 90s sometime, something like that. So it's an old book, but it's a good read. Yeah, so I'm still a paper guy. These are notes for last night's video. So I still do a lot of paper. I love paper. I love writing on it, all that stuff. So I'm that guy. I don't do a lot electronically. So back to it. Monthly Dower. This is important. On a monthly Dower, what we're looking at is three targets, 103 to 113. Seems a little far-fetched, and I showed you a little while ago that we get these recalculations, and usually you get a high calculation, it recalculates, and it squeezes it down. Well, we have gotten the opposite. We are expanding back out. So the projections were 100 to 107. Now just got a new projection at 103 to 113. So it's expanded out a little bit. That middle one is 104.70 on the previous calc, and we're looking at 103.95 on the new calc on the minimum. And as I said, I usually look to that minimum target to start with. We're seeing PPMs. This is a monthly chart we're looking at. We're seeing PPMs starting to roll up. So I suspect the Dow is going to continue to be strong. The market grid should turn up. It's going to update tomorrow. If I have the time, maybe not in tonight's video, but maybe tomorrow night's video on Friday, I'm actually going to make a note to myself, maybe to at least mention the Dow. But I do think this is going to be moving higher, and therefore we're going to have a hard time getting gold to do what we need it to do if you're a bull in gold. And I was very bullish in gold, but the patterns are starting to deteriorate. And I wouldn't argue that somebody just said gold is trash, and it probably is. But let's go over and let's do gold. I don't know if I can get this to expand or not. Let me try something here. Yeah, that'll work. This goes back to some analysis that I did a number of months ago. We did get up to this almost to the 0.618, 1939. That was the end of the party. We've got a bit of a reversal going. But we look at the PPMs on this chart, we're going to get sandwiched here. And for the month of July, we're actually trading. I was talking about one of my mentors in book value. I would call this probably decent book value. We're trading below the 21 month moving average, you've heard this number if you watched any of my videos, 1776. That is your demand line. We've been above it and below it. This goes back all the way back to February. We were below it in March, back above it in April, well above it. We bounced off of it again. The low was 1760, or the average was 1765. The low in May was 1768, so $3 off of that number. And then this time we're back right at it. It's 1776. We're trading 1769. I think with the Dow analysis I just talked about, we may see a month where we're below it, and we are starting to see the momentum bleed off pretty substantially. So let me just bring this back up so you can see this. PPM1 is a negative 1.21, so probably what we're going to see, 1776, that number is going to come down a lot. Let me just estimate that number. Yeah, 1800 is going to be a cap on this thing, and we could trade down into an extreme in this pattern right now would be down to 1606 on gold. It could get pretty darn ugly from here. So, but you can see the PPMs. This is monthly. Let's go, and I cover this every day. So, but I did want to bring up that pattern there. As far as the weekly goes, we're trying to turn up weekly. PPM 2 and 3 are trying to turn up. So this may be the low 1678 is the low that we had in March. I've talked about the short-term number was that 1761. We took that out, right? We've been down so far this week down to 69. I'm sorry, to 50, 1750, and I think we'll probably see some further numbers down as we come into next week. So we'll just based on the goal or based on U.S. dollar, all that stuff. So let's get into I was thinking about that. Hang on. Let's bring up the weekly silver chart. I haven't covered silver for a while, and it deserves some time. So same thing in silver. It's starting to show, it's got a more positive pattern. I left this pattern recognition tool up here, and it still has some valid projections up to $30, $32, but the key level on this thing is right here, is 2381. If it took that out, then that would negate that upward pattern, and we'd get a swing lower. We do have some low projections right now. I'll bring that on screen so you can see that. Low targets 22, 27, 1972, and 1857. But overall, the PPMs are trying to turn up. They're not no comparison between gold and silver here. Gold is firmly in downtrend, and silver is neutral, and the longer term average is positive. So we're looking at let me just get the right number. Yeah, 2583 is major support here, and we could continue sideways in a narrow range for another week, but silver's no comparison. It's actually much better looking from a trend level than gold. I'm not waving to you folks. I'm trying to get my camera to work, and it's not. Bear with me. Sorry about the camera, folks. It's a problem. You have an AI camera. It's supposed to follow me around. All right, let's see where we are. Let's do Bitcoin and Ether, and then what time we're getting to be. We'll go through some individual stocks. Don't give them to me yet, because they'll get lost on the timeline. So just hang with me for a minute. Thank you, Richard. Appreciate it, man. Okay. So Bitcoin, I actually think we're very close. There's some very interesting patterns starting to come out of Bitcoin. And let me bring this up. We've actually got a dual. Thank you for delighted for reminding me about crude oil. That definitely, I will do that next. So we'll go ahead and hit the cryptos real quick. There's not a lot to say here, but we are looking at setting up a bottom here. PPM1 is starting to move pretty quickly. The formation of these PPMs are actually very positive, so I don't see a full out collapse, not going to 16,000, not going much lower than what it's already been. This is the daily graph. If we go over to the weekly, is it very interesting? And I remember doing the video when we were at 13,000, and I had projections right here. Let's see here. Let me just bring those up. And I had projections right here back when Bitcoin was around 13, I think. Just trying to see where it was. Close 11. And I did a video on the channel, Bitcoin to 23. It seemed kind of crazy at the time. The projections were 23,721. If you look where my cursor is here in the middle, that's where it went to. Same kind of configuration right now. Brand new, like just came out. The target is 85,000, 106, 119. God, I'm going to have to hang out with Kathy Wood. I mean, she's only expecting 500,000, and she's starting a new ETF on Bitcoin. So she'll definitely be a goddess then. If she sets up an ETF on Bitcoin and it goes to 85, she will be bowed down to everywhere she goes. But this is the Fibonacci pattern coming out here. A lot of times we get these kind of patterns, they don't play out. So I'm not totally buying into this. There is another number that's on this sheet here at 60,612. That is, write that number down. Write this number down, okay? 60,612. That's the pivot for, if we take that out, 85 plus is on the table. Not saying we will, just saying if we do. I'll update this, but PPMs on a weekly basis are very negative. So we're similar to how gold looked the other day. So there's probably like one more blow off bottom on this thing before we get done, but we should hold in within the expectations of the grid. Okay, so this is a weekly grid, and that extreme number right now is on the screen. It is 28,450 to 26,608. Last week we got down to 28,824. So maybe a retest. We could make a lower low. There could be one more low, and then this thing's ready to roll. But the dailies are suggesting we won't get that low. So we're probably looking at 32,908, something like that. And we look at the grid right now. S1 32,572, S2 30,511. Somewhere in there is your magic number, and I'm not sure, based on the daily chart just looking at, I'm not sure we're going to be able to get to that. And in fact, 33,890 is the low, and we're about 100. Yeah, we're what? Where are we at? 1,000 points off of $1,000 off of that level. So let's do Ether, and then we'll go to crude oil. Thank you, Deloaded, for that. I really appreciate it. That's part of the inflation scenario is crude oil. So let's go to Ether real quick. Ether doing pretty good today. Interesting number, just same weekly chart. Ether's got a projection now on the screen. 4,099 is that pivot number. That's right there. And then you have the next numbers: 59, 31, 74, 86, 84, 50. I'm rounding off, 84, 47. So that's the same pattern. And I left, it's interesting because I left those pattern recognition tool on there. And yeah, so this is going to be interesting. PPMs are negative on PPM 1, but not so much. And all we're working about getting above the 21-week moving average. The 21-week average is the demand line right now for this thing. It is 2250. So we're trading just below it. So look for that thing to climb back above there, probably get into maybe, just looking at the numbers here, looking at R2 21, I'm sorry, R3 2283, probably be the extreme for this week, but look for it to climb back. And this is a very interesting formation. So you've got all that. All right, let's go to crude oil. And these numbers I've been talking about as well. This is the weekly crude, and crude oil is actually set up very nicely. The PPMs are super positive: 1.74, 1.26, 1.49 PPM 1, 2, and 3. Those are that angle of attack that I talked about earlier. That is in play here. The minimum target here is for 90, we'll call it $91, right? We're trading 73.50. I remember not that many weeks ago, I said we're heading for at least 76. Kathy Woods is telling us that it can't go above 76. I think it's going to go to 90 and probably back to 100. And if you don't believe me, just look at what's going on in Europe. There's a big squeeze going on. I know some of you are over there that are listening right now, and I appreciate that because it's getting pretty late at night, so I appreciate that. But there's a lot of shortages and all kinds of stuff going on. There is a movement in the G7 that it's all about green and they want to kill the fossil fuels. I went into a big rant last week. If you want to watch that, go back and watch last week's show, because I went into this, is that they're choking off the supplies. They want this to get more expensive. They want to exert as much pain so they can give Tesla more tax credits and put up charging stations so more and more people will adopt. And I'm not saying it's bad, okay? I'm just saying there is a game going on right now. You know, you see that in the pharmaceutical business, right? They're always, you know, you don't want a generic drug that has no license. You want to have the license on something that you can make money on. Same thing here. There's a lot of money in government contracts and expanding and pushing the EV cars out there. And sometimes when I say this, people think I'm against EV cars. I think they're really cool. I told you last week, if you want to see a cool EV car, look at the Mercedes EV car. Teslas are a piece of plastic shit, okay? All you gotta do is ride in one. If you own one, I'm sorry, I didn't mean to offend you, but look at the Mercedes. And they're 20,000 more, you know, and have, yeah, anyway. Yeah, just look at it. Tell me that Tesla is a good car once you look at that. So there's going to be lots of competition for Tesla. Yeah, and yeah, Jason Bourne. Yeah, exactly. Yeah, they're pushing it, but they have no infrastructure. We don't have any infrastructure here. It's a joke. You know, they're building a truck stop behind me. Okay? They're not building an EV station. Okay. You guys get it. All right. So crude, that's crude. Let's look at a short-term chart before I move on. Nothing really there. No Fibonacci's. Trend, all in uptrend, even on a short-term basis. Probably by the time we do the show next week, we're going to be above 75, 76, and moving higher. There's just no reason for crude to go down. And especially with reopening trade, and my argument last week, I'll just mention it, is that the argument is that it will take decades to replace fossil fuels. There's too many things that require fossil fuels, and my comment was all it takes is one guy to figure out how to go 10 miles on a little thumbnail full of oil. And I'll tell you what you are seeing that's becoming pretty popular right now are the hybrids. The hybrids are really taking off right now. That's probably a decent solution for the EV. So at least you still can get around. You don't have to spend hours, recharging your vehicle, because most of these high amperage charging stations don't exist. Yeah, and Deloitte, I agree. This is my point. When economies get fully open again, whatever that is, crude's not going down. Okay, I mean it's not going down. Watch, it'll collapse tomorrow. Having said that, but it's not going down. Yeah, and that's the other thing. I'm just looking at some comments you guys have here. I agree, Jason Bourne. Hydrogen cells have much better future, much more, I think, impact on the world than you could ever dream about electric, because you still have to make the electric, right? The hydrogen is magical. And I mentioned this before, and it's interesting because it's actually become somewhat of a doctrine. There's a book that I talked about a number of weeks ago. I had 3 book recommendations today. This is a stellar one, is Natural Capitalism. And they talk about the credits, the carbon credits. We were starting to see that. They said it would happen within 20 years. So it's 2021. Book came out, I think, in 98 when I bought that book. It's an old book. I thought it was pretty interesting. A lot of stuff that they talked about is happening to a point. It's not fully where they thought it would be. All the concepts are actually happening right now. But take a look at that book. I don't want to get into a book review at the moment. But it is worth a read, and you'll see a lot of things that are happening, like trying to get, a consolidation of populations and getting people to be closer together again. That's like a big thing that they want to do, and the current administration wants to do that with high density apartments and all types of other things. I'll leave it at that. Yeah, that is the issue with the hydrogen, but I think overall that's the ultimate solution. I think you'd be surprised if there was money in an H2, there would be a lot of folks working on it. So strong dollar. Good question, John Palmer. a strong dollar you would think would affect that, but it's the choking off of the supplies, shutting down Anwar, shutting down Keystone, taking away leases everywhere you can here in this country, getting us to have to go out. Even just everywhere they're shutting things down as far as capacity goes. At least they're attempting to. So there's other places and countries that are coming into play there for sure. Yeah, and I agree, David Ford. There's no single solution. That's the point. But they want to act like there is only one. And certainly, if you're Elon Musk, you got to love the dialogue that's going on in society today around EVs. And actually, he was, I think, very honest. You even hate Elon or love him, but he basically said his whole goal was just to get the electric concept out there. He didn't even care if the company went. He didn't care if the company went bankrupt if he managed to get that out there. So that's an interesting view. It goes to a lot of things in life. When you try to do things for the wrong reason, you don't get rewarded. And sometimes you do them for the right reason, you do. Yeah, that's intro. This last comment is kind of interesting. I have to look into the BSC, look into, it just confirmed listing a BKEX in 2 days. Interesting. Yeah, and you're right, but let's see here. Revers Games, you're right about that. They would have to increase it. They're going to increase it a lot. I don't know that we get up to $2,820, $150 a barrel, but it's going higher. It's actually printed up since we started talking about it. All right, so what time we got? 20 minutes to the hour, 20 minutes to the close. Literally, let's see here. Well, we have seen a little bid come in. Let's take a look at, let's pop over here. We're almost at the high of the day on the E-minis right now. Just in the last 3 or 4 minutes, we popped from 42.86 up to 90 to 90. So we got a little four-handle pop here. We're trading at the high of the day in the futures. If we look over here and just, let's go over to E-minis. Daily, look at daily grid. Bring that on screen. 42.99 R3. We've been 86, so we're above R1, above R2 at 42.92. So we're almost to R3. And I, as I mentioned when I covered the S&P earlier, is that 4308 is a big number on the sheets right now for me. So that's a number I'll be watching for the next several days, and looking for any kind of suggestion we're going to get things higher. And like I said, here's even on the E-minis, we're seeing some acceleration in the PPMs. No, actually, we're long PLTR now. You guys think I'm some static guy? No. Matter of fact, let's put that on screen. Let's go over to Portfolio Expert. I love you guys. I love you trolls. You're awesome. Let me go to. Let's go over here. Yeah, so PLTR I said would probably go to 15. It went to, on an overnight basis, it went to 16 and change and flipped around. We bought PLTR. at $22. And if we look at, let me switch this over. Let's go back to this page here. We got a flash flood warning in Arizona. So we've got forest fires up here, and now we're getting rain, which is a real good deal. Let me just go over to here, and let's bring that up, because I think that's you know, a lot of folks that watch this channel don't actually get what we do. Okay. So on 5/27, 22.1, we bought PLTR, and we're up 21% on the trade already. So thumbs up, right? And even since I've got this on screen here, let's put up ARKK. I said ARKK was going to 95. It pretty much did. We're actually long ARKK from 112. It's 130. We're up 16.4%. So this is what drives me, not some opinion that I had about PLTR 4 months ago. Okay. Anyway, yeah, I love it. All right. I did not cover TLT, but I did do the 10-year. I guess same thing, somewhat. I didn't say it was going to 0. I said it was going to $15. And regardless of, you know, you really should subscribe. 21%, you really should. You should really figure out, you know, yeah. I was being sarcastic and a smartass, but I did say it would go to 15. It went to 16 and change. I did say ARKK would go to around 90, 95. It did, and glad to buy it when things go up. I have a portfolio that I rebuilt of Kathy that I'm still beating her by a long shot on utilizing her same stocks that she's trading them differently. Instead of buying every damn dip, actually going to cash and then rebuying when they bottomed. Works a lot better than the crap she's been doing. So she's only coming back. If you would have thought on ARKK, you would think that, well, the Nasdaq's making a new high, so should ARKK. Now they're hardly they're positive on the year now. So anyway, I think a lot of my ARK stuff is up 14% or something. So anyway, enough about that. Let's get to some individual stocks, and let's do that. That'll be more fun. So why don't we, looks like you guys have already started on a few. CVX. Okay, cool. Thank you. So let's some of the stuff I may be able to get, especially on this. Yeah, we got to do NEO. Yeah, I agree, Zeke. That's a good one. BAC. All right, I've got. Yeah, we can do. All right, I got quite a few here. So let me run through these. I'll try to be efficient so I don't get bogged down on any. Yeah, I'd love to just cover all these. You know, what might be kind of cool one day is just do a quick review of the markets and then all individual stocks. That'd be pretty. Yeah, I could do that. That might be fun. I have to drink about 3 of these. Yeah, so NASDAQ has just went positive. We've got Russell up 0.27, S&P up 0.2. So Russell's trying to make a little bit of comeback after yesterday. All right, so let's get through these stocks and see how fast I can get through this stuff. I'm going to start off with CVX. You know, I'm kind of, this is an interesting thing. I'll just make a comment. I'm going to go through a couple of these oils that you folks have proposed. Is it a lot of times these primary, you have to go almost to the refiners. There's different elements that play out in this market, and I'm not a pro at this by any means, but I've watched this. A lot of times when crude oil is going up, these stocks don't do as good. There's a lag, at least a lag. So maybe if we get to 90, then this will start to move higher. PPMs are actually negative here. PPM 1 is a lot of resistance right here at the 10 period moving average, which is 105. We're trading right up against resistance. The PPM trying to turn over on a daily. Let's go to weekly. I think we're going to have to, I'm going to stick to weeklies on all these so I can get through them. Weekly does have a Fibonacci projection 129, 140, 147. So that's interesting. We're trading right at the 200-week moving average, which is at 108.96. So we're trading down on that 104.52, which is the 21-week moving average. PPMs on intermediate basis look a lot better. Look like we want to move back above somewhere over 112, and then you see the target's 129 men. I'm just going to do a couple of these oils that are out there. Do ExxonMobil. Very similar, trading right along these lines. This weekly, looking like, you know, PPMs are really solid. This is probably the better trade here. So look at 85.74 target men on the upside. Get a close above this 200-week moving average will be in good place to move higher. That is 66.04. All right, I'm just crossing through some of these as I get through them. Okay, I didn't think I'd get that one. Wow. Yeah, this little penny stock, not going to be able to help you out. Viz Connect, this was the, wait, maybe I did it, maybe I thought okay, that's a little better. I fat fingered that one. So we're up 125. Interesting pattern. There is some 112 crazy projections, pivots, $94 on this, like a double from here. PPMs all over the place. I'm not sure what triggered this volatility. You probably know about that, but the we'll just call it 51.66 is going to be probably the cap on this market for the moment. So we'll go to NEO and Tesla. NEO's getting on a weekly RXT sell signal, but that just means we're going to go sideways, consolidated. There's no real valid projections, but the PPM1 is very solid. In fact, 4158 is the 10-week moving average. The low was 4381, so we didn't quite hit there, but this is a pretty positive pattern. The pivot, the big pivot number is right here, 6201. Break above that, then it pivots. This thing will definitely make a new high and probably go a lot higher. We'll have an opportunity to talk on that. The minimum target's like 100 on this thing. Let me see what that number is. This Fibonacci target is min 96.79, 121. So those are pretty big numbers, to say the least, right? Let's do Tesla's got a similar pattern. PPMs are trying to turn around. These are all intermediate charts. Down a little bit today. We did trade up to, let me get these numbers on screen so we can see them. The high's 694, R2 699 weekly, so we're up there. But we do have some Fibonacci projections on the upside toward the $788, $880 level on this chart. So this thing is trying to make a turnaround. We still need PPM1 and 2 to get positive to make that happen. So my expectation here would be stay within the grid, that grid range. So, you know, maybe on the relaunch, you can, this is the grid level. You probably extremes S2, R2, we're trading basically R2 almost right now. So we'll probably end up with a slight positive moving higher into the pattern there. Let's hit on, let's do Bank of America. This is interesting because Bank of America has already traded into right up to its projections that we have here, 45.12. The high 43.26, so we're looking right into that range right there. PPM's positive across the board, pretty good looking chart. Extreme 47.77 right now. Don't see much about that, but this would go hand in hand with the scenario I'm painting out over the next couple of weeks on the interest rates if you go back and watch that section. Yeah, Craig, what's the symbol on that one? Is that net? Is that what that is? Yeah, okay, I got it. I'll cover that for you. Thank you. What did you say? Yeah, so as far as this one goes, we're down a little bit here today. Not a lot of history on this. Let me see if we have this in our system, okay? Yeah, we do. So I'll just bring this up on our platform. We did recently get a buy on 1-2 on this thing. Let me look at 3-2 here. I'll explain what I'm doing here in a minute. Yeah, so our 3-2 weekly bought this thing at 18 bucks. It still holds it. You're pretty close to some kind of peak. So if this is a trade for you, you could look to maybe put a trailing stop or something on this. Um, I don't really see, from a PPM standpoint, we're still accelerating, and this trend could be probably into a wave 3, so we could see some higher prices here. I'm going to go back to TradeStation just so we can see it. There's no Fibonacci targets right now, but it does look like some very positive trends here. All the PPMs are in the 2.74. So the worst case that happens, you get into a consolidation here, and then there should be some higher numbers out here. I don't know that they get to these objectives up here at 127 is possible, I guess. But the trend is well in place there. So I would, you can. I always say trick the market gods, make them think you got out, and sell a little bit of your position and hang on to a core, maybe add to it. Okay, where are we at here? We got 3 minutes to go. Let's flop over and let's watch this close real quick here. So we traded to 93, which looks like it was about the extreme. So we traded up there just 2 minutes ago. We've got a little bit more than 2 minutes to go in the close. So I'm going to go full screen just so we can focus on this. Yeah, the market gods, that used to be that was one of my old buddies on the trading floor. Artie used to always say, he goes, never celebrate a trade. If you are celebrating, you better be celebrating with an S, like celebrate. And he goes, the market gods know you're celebrating, they'll take your money back, and then sometimes you have to trick them and make them think you sold. So that's where that came from. Pacific Options Exchange, 1992. Okay, about a minute and a half to go. Looks like we're probably going to stall here. I'm not sure anybody wants to come in here and bid the market. We've got claims and continuing claims, some other metrics coming out tomorrow. I don't think everybody's going to be on hold until Friday, and it's going to be a big day because everybody's going to want to square up before the long weekend, right? A little bit of selling coming in. Prints 89.25 low. We're in the final minute of trade. Not a lot of volume on the close today. A lot of times we'll see over on the far left, this is a level 2. A lot of times you'll see this thing print up to little bigger numbers. So that just about the party here. Final 15 seconds. All the way down to 87. There we go. That's the party. So I think the low on that print was 85.25. So that was a decent print down. Yeah, so yeah, the bell definitely rang. So yeah, and they covered them up on the close. So what I've talked to you folks about this before. What this means is, like all the ETF mutual fund guys had some sell orders and they overcovered, and now we're almost printing to the high of the session here all of a sudden in that final. I always tell you, watch the last 2 minutes of the cash and the 2 minutes of futures trading after the cash closes. Kind of tells you if anybody's making any. So there's a fair amount of selling coming in just on squaring up positions, and then they bought them back. They oversold. Okay. All right. So let's do this. I'll cover a couple more symbols, and then we're just going to call it quit. I want to bring up something. I brought up our platform again. It's a Portfolio Expert. Let me just want to see what. So I have I built a model. I have one of our institutional clients that was trading a lot of Roku, and I was trying to show them how they could easily, outperform. There's been quite a bit of volatility in this stock, as you know. But I put in a monthly, daily, weekly. This is what we call a multivariate trade. And right now, all three models are long, and I can tell you when the entry dates were. Let me just see if I can blow this up and zoom in, and I think you'll see this, and then I'll review the stock. So yeah, so the Roku monthly came in at 32.98 on 11/2/20. It's up 114%. The daily came in on 6/15/21. It's up 21%, and the weekly came in at the beginning of June at 348.97. It's up 26%. So those are short-term, intermediate, and long-term trades from there. If we go and look at it from a trend viewpoint, we'll see that we've got this accelerating trend. Looks like the all-time high here is 486.72, so we're definitely heading toward that level. We've exceeded any of the Fibonacci projections. The PPMs are very positive, all in trend level. So what's about to happen, this is the weekly, probably next week we're going to get the crossover of the 21 period moving average to the 10 period moving average over the 21, and typically that suggests we get a little consolidation. We'll trade back to the 10 over the next couple of weeks, which is rising fairly substantially, rising about $10 per week. So in the next couple of weeks we'll probably stay within the grid and then ultimately start to move higher. There's a long-term projection out here right now at some big numbers out there. That number is 583 is the min, so that would be an all-time new high. So it's definitely a good trend on this one. Looks like it wants to move a lot higher. Okay, Mr. Tater, here's your APPH. The do have some objectives, 24, 25 to $30. PPM's turning up. Still got a little negative, kind of a mix. So you're gonna need to get over around 1685, and you should be on the way to those numbers. Yeah, so somebody asked for GME. We'll take a look at that real quick. These are pretty tough patterns to read. This is the daily. Actually got some downward objectives now on this thing. It's 79. Low target 23. That's kind of scary. Looks like there's pretty decent support, but we're in downtrends, PPM 1 and 2, minus 0.4, minus 0.7. So I'd be really careful with this one, especially along this consolidation line. Be like owning Dogecoin at 40. It's on its way to 19. So it looks a little risky on that one. Got to do AMC, I guess. AMC's got an elongated dragon head, does have objectives 76.30, 85.95. PPMs are still all positive. Some pretty strong support here at 55.18. Don't see it getting down to the 40 in this pattern. It looks pretty solid. So, yeah, 76.30 probably on the upside. Just watch this thing pretty tight around this 55.18. Gets much below that, you could go down as low as 36. As crazy as these stocks are, volatility is likely. So, that's a big bet, Mr. Tater. Hope you're right. Hope I'm right. So just going to come on screen here for a minute, folks. I just want to thank everyone for spending all the time. I'd love to go through all these stocks. The old man gets tired about this time of the show. But yeah, so I'm thinking about doing something like that where we actually focus on just talking about stocks and groups and sectors. We need to maybe do that. Maybe that could be a theme for next week. I made a couple of notes on that because it'd be fun just to do individual stocks. You guys get there's a lot of stuff out there to talk about, and be kind of fun just to do a whole show without all the other stuff on your agenda and not mine. So that would be fun. So yeah. So anyway, folks, sorry I can't get to everything. I got on one of my long rants, and like I said, I will consider doing that. Like maybe next week we just do all individual stocks, and that's what I'll do. A quick review, let's say the first half hour of indexes and whatever going on in the world at the time, and who knows, maybe we'll get employment numbers, but maybe we'll have more to talk about next week than we think. Maybe I'm right. Maybe we get some kind of backtracking and the employment numbers miss. The ADP numbers might be indicating what we will see on Friday, but they're not really that closely correlated. They don't have a lot to do with each other. Anyway, folks, thanks again for watching. I really appreciate it. It's actually a lot of fun to do this. So, yeah, anyway, I guess we're done. So thank you so much. Hey, Brett, I was thinking about you. I might give you a ring. Are you available? yeah, anyway, folks, it's good to hang out. Don't forget to subscribe, hit the like button so the YouTube algorithm knows that you guys had a good time. So thanks again. Don't forget to take advantage of this deal, guys.